welcome to today's webinar. Hope you can all hear me out there. We've titled the webinar Analysing Our 7 Highest Conviction Calls. I'm going to give you a quick run through of what we're going to cover today. I'm joined on the call by Shawn Hickman and Harry Watt. Shawn's our research lead here at Market Matters. Harry Watt's our portfolio manager here at Market Matters. I'm James Gerrish. I'm the lead portfolio manager at Market Matters. I've got 20 years experience in markets. Shawn's got 30 plus years experience, probably going on 40 soon, Shawn. And Harry's going on 10 years experience in markets. So welcome to the Market Matters webinar to all our wonderful members out there and those who are joining the call as well. I guess just before I crack on and run you through some of the topics we'll cover today, one of the things that Market Matters does is bring real experience to the table. So not theoretical experience, but practical experience operating in the markets on a daily basis. We've been doing it for a very long time. We're a broad team now at Market Matters, so we've got 9 in the team. We're the lead investment guys in the Market Matters business, but there is a depth of knowledge there. And one of the things that we've really worked hard on over the last 4 or 5 years is building a structure in what we do and remaining consistent to our approach. So I hope some of those things come through in today's webinar. Before I begin, just a quick disclaimer I should run you through. There's just a quick overview of the 3 guys that will be speaking with you today. Just a quick disclaimer that any advice provided in today's webinar is of a general nature only, and you should consult a financial professional before taking into consideration or taking on any of the advice provided in today's webinar. We're going to go through 7 stocks that we like here and now to provide some real actionable ideas. We'll give a quick overview of where we think of markets at this from the outset, and we're all going to do it via the Market Matters platform. So the Market Matters website, I'm going to get onto that very shortly, and I'll bring the other guys in. Shawn, Harry, say hi to the panel.
G'day guys, good to be here.
And you're there, Shawn?
Morning everyone. A bit slow with the technology because of my age. Thank you very much for that, James. But yeah, I'm here.
No worries at all. More experience in the markets than on Zoom calls. All right, so we're at a really interesting juncture in terms of markets, and when you pen a report every day, and no doubt subscribers out there will be reading the reports on a daily basis or trying to, we articulate our views on a daily basis in the market, and we publish those views via a daily email. But those views are also available on the Market Matters website. So for those who are new to the Market Matters website, this is a dashboard. This is your dashboard. When you log in, you'll be able to go and see, this will be your first port of call, and it's sort of your navigation panel to go through the rest of the Market Matters website. There's someone trying to call me now. Shawn, I'll just give you the opportunity just to give you a quick overview of where you're seeing markets from a broader sense. I'll bring up our AM report today, and I'll just put on a chart of the ASX 200 so that you can see it. But how are you seeing from a broad perspective markets going into the back end of 2023 and early 2024?
Thanks, James. I think firstly, I am expecting, as people know from reading the notes, I am expecting a Christmas squeeze. It's nothing unusual. It happens probably about 8 times out of 10. If we look at this morning, the market's up 1%. So maybe it's already started the rally. It doesn't normally start until mid-December when the banks start paying their dividends, and some of that money flows back into the market. But in a broader scope, I think we're going to see a lot of sentiment changes day to day, week to week, month to month, all around bond yields. The market's starting to look at how they're going to, whether we're going to get rate cuts next year. If we get rate cuts next year, how big are they going to be? It was only yesterday where they decided, or the market started pricing in, that the RBA wouldn't raise rates. So the market's got a little bit ahead of itself, in my opinion, James. It's decided, okay, we're not going to get rate cuts. And that's why we've had a huge rally through November, early part of December. What I now believe is we're going to get the sentiment swings are going to come in, volatility day to day, sector to sector will increase. But that's great. That gives people plenty of opportunity to structure their portfolios accordingly. We believe, and I believe, that the rate sensitive stocks will outperform next year. Interest rates, or bond yields in particular, are going lower, but it will not be a straight line reaction. There will be blips in the road. And I think it can be a lot of fun. But clients need to have, and subscribers need to have, some methodology and some plans in place so they know how they want to tailor their portfolios. If you haven't got that plan, this market could really be a tough one because you're going to be reactive rather than proactive.
Yeah, that's an incredibly good point about having plans and doing the work to form views, and then putting a structure in place to enact those views. And you made a really good point about bond yields. Just to give you an idea of where bond yields have gone over in the US, the US 10-year yield peaked above 5%. We're now down below 4.2%. So there's been a huge about turn in the market's pricing of future interest rate cuts over in the US market. Not so much here, but the real change here is that there's very unlikely to be any further interest rate hikes here, and that's been priced out of the market. It's been priced into the Aussie dollar, and it's been priced into bond markets. I am going to crack straight on so that we can get into as much detail around our stock calls at this point in time as we can. I'm going to start by bringing up. I'm going to show you how to bring up different stocks and how to search the Market Matters website, all in practical time. So the first stock we're going to cover today is the uranium company Paladin. Throughout this presentation, you're going to get to understand how you search things on the Market Matters website and how you can navigate through the portfolios and get more information on stocks as and when you need them. So just in terms of Paladin here, Shawn, uranium company, trading $1 a share. This is one that we hold in 2 of our portfolios, and you can see that down the bottom of the company page. It's held in the flagship growth portfolio, and it's held in the emerging companies portfolio. There's a nice chart that you can see on the Market Matters screen with some of the key share price movements, 1-year return, the range that it's traded in for the year. We then have the ability to go in and do some charting, if you like. So that's certainly something the Market Matters members appreciate. Then you've got a bunch of other financial metrics that are important when you're analysing a stock, and we'll go through these. We also overlay this with Market Matters recent insights into Paladin. So you can see all of our, when you see an email that comes out to you, we're writing about individual stocks. They're called opinions. And those opinions are broken up and put on the individual company pages so that any time in the future you want to go back and see what we've written in the past, you can see the opinion and, importantly, a history of our actions. So whenever we make a call, we're targeting $1.15 to $1.20 area in Paladin. This will be time-stamped and put on the action tree. It's a level of transparency that no one else does, and it's something that we really pride ourselves on in terms of Market Matters. But Shawn, uranium stocks, they've been hot. Uranium price is up above $80 US a pound. Paladin's been going particularly well. What's your take?
Thanks, James. It's very much a supply and demand situation, as all commodities are, but sometimes that can be easier to predict than others. The uranium price has already doubled this year, so we've got to be very conscious of that, and we've seen the price of Paladin double as well. But it's very, very different to the press we're getting in Australia. In Australia, you don't hear a lot about nuclear energy, or you hear nothing about it. Obviously, the Albanese government has said absolutely no way, Jose. It's not even contemplating or discussing it. But 22 countries around the world, including the UK, including the US, including France, have said they're going to triple their uranium or their nuclear capacity by 2030. That is not very long down the track. When these big major countries are acknowledging that nuclear is arguably the only way to go to get to zero emission by 2030, 2040, 2050, we personally believe strongly that the demand is going to go through the roof. It takes an awful long time to build a uranium nuclear reactor, an awful long time. Yet yep, the demand is there. Even in Japan, where they obviously had the horrendous Fukushima situation, they're starting to kickstart uranium again. So we believe the uranium supply demand is going to push the price of uranium even higher, and that will take Paladin with it. So I'm sticking with the $15, $20 price target, but the move is mature. It has already doubled, and we would be calling this a classic situation of sell into strength. We've only got a 3% position because it is a fairly high beta stock. Above $1.15, we'll probably tailor some of this, if not cut it from the growth portfolio. But likewise, if it was to take a really big spike downwards, maybe under 90, we might go up to 4%. So we really like this stock, but it is quite mature on the upside, at least for the next year. They're looking at going into production in Q1 of next year, and that could well be create the top. Sorry, James?
Yeah, that's exactly what I was going to say, Shawn. So if you think about risks, you touched on supply and demand. So it's a case where, supply has been weak, but it will come on stream as that demand side of the equation starts to pick up. Paladin's bringing their Langer Heinrich mine on in Q1 of calendar 2024. I'm always concerned about companies bringing on mines and the complexities that have. Nothing seems to go to plan. So that would be, we're bullish on uranium. We've got a good position in Paladin that we're up a fair bit on, but we won't be shy of trimming it or exiting it into strength, because we think it's going to be volatile, and we think there will be present opportunities going forward. The other stock in the uranium space I'll just highlight, and we've got it in our international equities portfolio, is Cameco. Just on the Market Matters website, you can go and put in stock codes if you know them down here by stock code, as well as US stocks, or you can search by company in the top panel here if you don't know the stock code. So Cameco has been another phenomenal performer in our international equities portfolio. To give you an idea, Paladin's about a $3 billion market cap company. Cameco is one of the world's largest producers of uranium. It's about a $20 billion US company. So that gives you a sense of the different sizes out there. I like Cameco because it is more of a broad brush producer, not reliant just upon bringing one mine into production. But I'm going to now throw. So Paladin is our first high conviction call in the Market Matters Magnificent Seven. The second one, I'm going to bring in Harry Watt to talk about Aussie Broadband. Harry.
Yeah, thanks, James. Aussie Broadband is one we've held in the emerging companies portfolio for quite some time. I think more recently we've seen it run pretty aggressively over the last 12 months, and it's probably a run that we expect to see continue. More recently, over the last few months, they went and raised a bit of money to buy Symbio. So they're working through that acquisition at the moment. You've obviously seen a little bit of weakness in the share price since announcing that acquisition. I think that's just more the market digesting that raise. Market has to deal with a bit of coin coming out of their purse to fund a raise, so they try and right size their positioning on the back of that. But this transaction, I think, is a pretty key deal for Aussie Broadband. They're buying a telco as a service business, so it plugs quite nicely into particularly their enterprise sales side of things at Aussie. These guys are growing their NBN business above market, so they're picking up market share across the board. They've got plenty of levers for growth, and they're starting to really manage their costs, which had been a bit of an issue for them for a few years there, but managing their costs a little bit better. So broadly speaking, we like the momentum in the underlying business. The share price has sort of stabilized since that cap raise that they've done. Share purchase plans are now done and complete and in the books. And I think this will be now a clearing of the slate for the selling for the short term and a stock we like into the end of the year and throughout 2024 at this stage, given those strong momentum.
Yeah, sorry to cut in there. So they raised at $3.55 a share. The raise was well and truly oversubscribed. So retail holders in the SPP got scaled back, which is obviously not ideal when you're trying to buy stock at $3.55, but it's a good sign of the broader demand for Aussie Broadband out there. One of the features on the Market Matters website is forecasts. So there's a couple of things that I'd highlight here. The first is a comprehensive stock report, which is sourced from the London Stock Exchange Group, LSEG. It provides some quant-based analysis of individual stocks, so you can click on the Get Detailed Stock Report and go from there. The next is around broker forecast. So this looks at consensus broker forecast. So the consensus price target for Aussie Broadband is $3.64, and then this also charts differences in the metrics moving forward. So estimates for 24 and estimates for 25. So you can look at the revenue stats and you can chart those, so you can clearly see, and you can chart combinations of those things. You can then expand out EPS and look at the underlying breakdown of where analysts are expecting these different metrics to be. So I think that's a pretty cool feature in terms of the Market Matters website. And of course, you can do the same thing on all the historical financials. So the income statement, the balance sheet, and the like. You can select different mechanisms within those and plot them so you can see them nice and graphically on the chart. So Aussie Broadband, Harry, so we like it. We've got it in our emerging companies portfolio, which you can see there. You can see Harry's nice head that he was on Ausbiz speaking about Aussie Broadband not that long ago. Then you can look at any of the questions that have been asked historically about the stock, and what we've said about it in the past. So, and again, all of our opinions and our actions are detailed on the Market Matters website. So you look at the last action, then you dig in and read the last opinion, and you can see that. Then you click on the ticker code there, and that will take you back to the company page. I'm going to jump in and give you a quick rundown of one of the stocks in our international portfolio. So if I have a quick look in terms of our international portfolio, you dump up into portfolios, you jump into the international equities portfolio of Market Matters. It'll give you a nice page around what the performance of the international equities portfolio has been over various timeframes. This is updated monthly, this top table. So this is accurate as at the 1st of December or the 30th of November. Performance. The changes here are as of the close price in our international portfolio. You'll see an added column in our domestic focus portfolios because it feeds 20-minute delayed data in, so you can see pricing or daily changes in that portfolio. So if I want to go and see UBS in our portfolio, so we bought it on the 22nd of the 8th, 2023. It was actually the same day as we bought Cameco. The current price is 27.72 and we're up 16% on the position. When we say active, it means we're still happy to buy it at these current levels. So an active tag next to a stock means we're still comfortable buying the stock. If I click on the ticker code through the portfolio screen, it will bring UBS up with all the same data that we've got for the domestic focus portfolios. UBS was an interesting one because we're high conviction on this because we think their purchase of Credit Suisse during the banking crisis, the regional banking crisis in the US, we read a lot about what happened to Credit Suisse. We wrote a lot about what happened to Credit Suisse. Essentially, UBS has been forced buyers of that business with the support of the Swiss regulator and on some very favourable terms. So some of the metrics around UBS at the moment will be a little bit skewed. So in terms of multiples, so PE multiples and earnings per share multiples will be a little bit skewed because of this CS acquisition. But ultimately, we think they're going to grow the top line very nicely from here. They've already had some meaningful success in terms of transitioning Credit Suisse clients into the UBS platform, whilst cutting all of the underperforming spaces of Credit Suisse. So this is a clean out, and we think they're going to do well with that clean out over time. So looking at the estimates, I mean, they were doing 34 billion in revenue in 2022. They're going to be doing near on 50 billion by 2024 if consensus estimates come to fruition, and that's going to have a big impact on a rise in the net income. So we like UBS. It's one of our preferred banking exposures at this point in time. So that is number 3 in our high conviction 7. So UBS on the back of Aussie Broadband and Paladin. We're going to stay in we're going to go back to the resource space and look at Sandfire Resources. Shawn, copper producer. That's been pretty much the only copper stock locally that's a big producer that's in the top 200.
Thanks, James. Yeah, I'd say yet again, Sandfire is a bit of a supply and demand story with a twist this time. So China is probably the big wild card here. China is 50% of copper use, and we all know that the Chinese economy at the moment is in the doldrums. Conversely, on the other side of the coin, we've got the EV story, and the pickup of the EVs is tremendous. However, the two are offsetting each other, and what's the end result of that is that Sandfire hasn't really moved a great deal for the last year, apart from a push up and down. And we've taken opportunity of that. It's a great example about how at Market Matters we will be active within a position if the opportunity arises. So BHP bought Oz Minerals, as we all know. Oz Minerals we were long Oz Minerals at the time. It was our preferred copper play. BHP bought it. They agreed with Market Matters, and it gave us a great return from Oz Minerals. And we immediately bought into Sandfire Resources because we wanted to maintain copper exposure. A lot of people followed suit. They all wanted copper, and it pushed Sandfire through $7, where we felt at the time was overpriced, and we took some off the table, as James is showing you now. We've now subsequently bought back into Sandfire. Harry bought some Sandfire last week for the emerging companies portfolio. Anywhere around this $6 area, we believe Sandfire's great value. But there's a few.
Yeah.
Sorry, James, go on.
No, I was just going to say, so I'm just running through just a quick overview of the Market Matters active growth portfolio, which is where Sandfire and Oz Minerals was held. You can go down and see the recent sales in that portfolio. It details all of the outcomes that we've achieved in that portfolio over an extended period of time. So it breaks down all of those type positions. So you look at Sandfire, the last trade we did, we sold it just shy of $7, as Shawn was articulating, and we're back into it below $6. So again, you can see the string of the actions relating to Sandfire, and every time we've written about it, every time we've mentioned it or had an action on Sandfire, it's detailed in this update.
Thanks, James. So that was a great example of us getting it right. I wish it was always that easy, James.
It's not,
but it's not, as everyone knows. There's a few other moving parts here. So Sandfire became the proxy for the copper play in the ASX, but Evolution Mining and BHP are also coming not too far behind. Evolution Mining's just raised money today. The stock's getting hammered accordingly, but they will be doing 30% of its revenue next year will be from copper, and BHP, since it bought Oz Minerals, is increasing the copper footprint as well. So we are getting more options going forward, and we won't necessarily always be in Sandfire for copper exposure. Let's put some numbers on the back of this. The average EV uses 4 times more copper than a combustion car. That's a huge amount. I read today it was over a mile of copper wire in a new EV. So, we think the demand will be strong, and unless the Chinese economy really slows down further, unless we see a recession, we believe it's a matter of time until the copper price can pop again and we see Sandfire well above $7. However, I would stress again, I wouldn't be surprised, a bit like talking with Paladin, that if we see Sandfire in that 550, 750 range over the next year or two, because in about 4 years' time, there's a lot of copper production coming online, and it will meet that rising price of copper. So it's always the same thing. Supply and demand, prices go up, supply increases. Don't get too married to a position. Constantly reevaluate both the reason for the position and also the stock that's playing that position. Right. So just to reiterate, Sandfire here, I think it looks good, but we might not be owning it in a year's time. We might own more BHP. We might own more Evolution because we do like gold, bigger picture.
Yeah, so I guess what we're saying here is that commodity stocks, resource stocks, obviously have a huge, are influenced heavily by the underlying commodity price, but we're active around that. So we have views around where the underlying commodity price is currently and where it's likely to go. That's predicated on our views around supply and demand, but there are also other factors coming into play. So the US dollar is a really important thing in terms of pricing of commodities, particularly gold. Um, we think the broad energy transition, I've spoken about this a lot recently, is going to be a huge global shift, and it's pretty clear that it is, that over the next coming decades, and copper is going to be central to that in a whole bunch of areas, not just EVs, but they are important to the demand side of the copper equation. So we like Sandfire. We continue to hold it. It's trading $6.27 on the market today. We've got positions in the active growth portfolio in Sandfire. Currently, we've also got positions in the emerging companies portfolio. So when I look at the active growth portfolio, we have we increased it to 4%. So we're only in there from 585. So we're not up a lot in this position at the moment. We're up nearly 7%. In terms of the what I was just talking about previously around daily change on domestic portfolios, Evolution, you can see that it's down 14.5% today. We're going to focus, we're going to cover Evolution at the back end of this presentation because I think it's really interesting. And ultimately, I think it's probably a buy at these levels. We've got a 3% portfolio weight. The discussion is whether we want to increase that or not. We did purchase Evolution at lower levels, so we're in there from 283 back on the first of about a year ago. We've held Evolution, so we'll get to that very shortly. So we've got Paladin, Aussie Broadband, UBS, Sandfire, National Storage. This is
one other point. Sorry, James, to interrupt.
No,
one other
jump
point
in,
I think
mate.
it's really important for subscribers to understand is that stocks often move, or usually move, 6 to 12 months ahead of the commodity price, and we've already seen that this year with the collapse of the lithium price and the lithium stocks. Just because everyone knows we're going to use more EVs in the next 5 or 10, 20 years, it doesn't mean that copper is going to be a raging success. We have to keep an eye on the tape. We can't keep our head buried in the sand and say we're right, and suddenly see our stock halve. So that's what we think is going to happen today. And I like the risk reward very, very much. But we will keep flexible, because if we hadn't been with things like lithium, it would have been a horrible year for us and a lot of subscribers.
Mate, I couldn't agree more. The bullish positioning, the bullish rhetoric 12 months ago around lithium was simply phenomenal. And you look what lithium has done. I know that's a really clear example. And now no one wants to know the likes of Pilbara. At current levels, it was down 8.5% yesterday. It actually is starting to look from a risk reward perspective. Now is the time to be wading back into those stocks. But I digress. The next one that we're focusing on is in our more defensive active income portfolio. So this is a portfolio that combines equities as well as fixed income securities, hybrids, some government bonds, and the like. And I've got this wrong actually. National Storage resides in our flagship, in our active growth portfolio. Apologies about that. We've got Centuria and Dexus in our active income portfolio. Anyway, you can see the active income portfolio there. Apologies, guys. Thanks for keeping me on the straight and narrow, Shawn and Harry. So, National Storage. It is the Australasia's biggest self-storage facility, or owner of self-storage facilities. We really like it. We've bought it just shy of current levels. It has National Storage historically has traded a big premium to the value of its underlying assets, the NTA. A couple of things have knocked National Storage. The first of them was rising interest rates, which are obviously a negative for things like property. We've written about this a lot in recent times. But also there was a spin out from Abacus. They spun out their Storage King assets. They had a little bit of trouble raising money for this spin out, and they were forced to do it at a pretty steep discount to NTA. When you compare Abacus to National Storage, Storage King was getting priced at a pretty significant discount to where the NTA was when National Storage was trading at a premium. relative valuation kicks in, and National Storage dropped on the back of that. So we like it. We didn't buy the low. We bought it around this $2.25 mark, I believe. I can go in and check that. But again, this is a high quality property exposure that is yielding around 5%, but it's got decent growth as well. So one that we like there. Have you guys got anything to add on National Storage, or I covered that one off?
No, and I think next year some of these defensive stocks with rate sensitivity, as I said earlier, will outperform the market. So I like it a lot. Very happy that it's in our portfolio.
One of the brokers are fairly mixed on National Storage. So you can the other feature here is it tells you what brokers are saying about or what their recommendation is. So there's 2 sells, there's 4 holds, there's 1 buy, and there's 3 strong buys. So the consensus price target is 237 in terms of National Storage, and you can see some of the metrics that I've spoken about before. So this is sort of it's got some growth, it's got a solid yield, and it's a really solid business. It has attracted private equity interest or trade buyer interest in recent years. So that's obviously something that could play out in terms of National Storage.
I think also, James, there's a global macro player underlying here as well, which is we are going, as the population grows, we are going slowly but surely into higher density living, with, unfortunately, we are still collectors of more stuff. And that all helps National Storage. You got smaller house, smaller apartment, you got more stuff. It's got to go somewhere.
Absolutely. So, I mean, I look at this, I look at a simple trend like this, and this is something that subscribers can utilize. You just look at the earnings they're producing. So in 22, they did 126 million bucks. If consensus forecasts are correct, they'll do 155 million in 2025. If all things stay stable, share prices follow earnings. The earnings are going up. The share price should go up. The key variable that Shawn made mention of there is sort of the macro backdrop. If interest rates, bond yields decline, and you've got this tailwind around further use of self-storage, then the share price and earnings could kick higher than where expectations are at currently. So that's what we're backing in terms of National Storage. We're not this is a high quality company backed by assets, run really well. We haven't tried to go the value end of this space. So Storage King is probably cheaper than National Storage, but it's not the highest quality operator in the space. So National Storage is number 5. Harry, you still awake there?
I'm still here, James.
That's good, mate. That's good. We're going to bring Harry in to highlight SRG Global. This is an interesting company. I actually really like this company. It hasn't done that well, but it's an interesting one nonetheless.
Yeah, we're sitting about break even on the position at the moment, James. Asset care, asset maintenance, mining services business. You can see once again my mug there, chalking up SRG on Ausbiz a couple of weeks ago. Overall, it's a really high quality business that's done really well. So they won about $1 billion of contracts last year. They're on track to do the same this financial year, and that just underpins their earnings growth that they're expecting to come through. So they're looking at about 20% growth in earnings in FY24. That probably will prove conservative. It's a number that they upgraded a number of times last year. We'll probably expect to see them do the same this year if they continue to win contracts at the rapid rate that they are. I think one of the main concerns around FY23 was their cash conversion was a little bit light, but that's probably in line with the growth they're getting through. So they're sort of having to front up a bit of working capital to get these contracts on board and get them up and running. I think that'll pass through, and you'll probably see that cash conversion number rise through FY24. Big A class clients, government clients, BHP, Illumina, South32, all clients of SRG. So their assets, their contract base, I think, is really quality, really high quality, and they're starting to see the earnings on the back of that. So trading cheap here and now, James.
Yeah, it is. So 13 times you can see that it's about 10% up from the bottom of its 52-week trading range and yield 6.2%. So that's an interesting one in our emerging companies portfolio. Has a market cap of it's smallish, so it's about $330 million market cap. But you can clearly see how revenue estimates of the prior year, actuals of the prior year compare to the estimates for the year ahead. So good growth coming through in terms of SRG, and we like that stock. That is number 6. And then I'm just going to bring the income portfolio, so it does get a start here in terms of our latest income portfolio purchase was ORA, which is Aurora. So it's an industrial company. It's a global packaging company. It's one that we stalked for quite a while. So, and you can clearly see here on the portfolio section, the income portfolio, we bought on the 16th of the 11th. We paid $2.56. It's only $2.57 at the moment. So the rationale for buying this, we had it on our hit list for a while. The hit list is another function that you can see on the dashboard of the Market Matters website, but it allows you to add stocks to a list. It's like a watch list, and you can keep an eye on those sorts of companies and what we're writing about them. In terms of Aurora, they raised a lot of money. So they raised about $1.4 billion to make a acquisition of a company called Saverglass. Saverglass is a big high-end glass bottle producer used in spirits and the like. That was about a $2.2 billion acquisition. So this raise was a big one. They did that at $2.70 a share. It's trading below the raise price. So we wrote a couple of times, and you can go back and look at the opinions here around us holding out on this one. So you can see that we've written multiple times about it. We started writing that we like it, but we remain patient, and we eventually got it around the $2.55 mark. So it shows how patience and stalking positions can pay off over time. I don't think this is going to be I think this is going to be more of a slow burn. So this acquisition, I think the numbers that they're quoting around this acquisition, I think the numbers that management are talking about in terms of the earnings, the synergies, and the combined group are being understated. And I think there's more upside in a business like this that is being priced currently in terms of the markets. This is going to increase earnings pretty materially. It's a material acquisition, and all things being equal, this looks like the right time to be buying ORA for good growth and a solid yield while we wait. So we like that in terms of ORA is our number 7th pick here and now for our Magnificent 7. So just to run you through it, we suggested Paladin first up, PDN, Aussie Broadband, ABB, UBS, UBS.US, Sandfire, SFR, National Storage, which is NSR, SRG Global, which is SRG, and then Aurora, which is ORA. You'll also notice when we're presenting these stocks, we're all about thinking about things from a portfolio perspective. So I'll give you a rundown here. So we're bullish on resources, and we're most bullish on copper and uranium. So we've chosen a copper stock and we've chosen a uranium stock. There's 2 positions there. In the industrial space, we've got a global packaging company, Aurora, that's had a short-term blip that has meant the share price has pulled back. So we're using an opportunity to go in and buy a quality company at a discounted price. We've also got SRG Global, which is completely different. It's a contracting company. It's completely different to ORA. We've got a property stock in terms of National Storage REIT with a favourable macro backdrop for its earnings. We've got a telco that's growing faster than any other telco out there in ABB. And then we've got a bank in UBS that has done a really good deal buying Credit Suisse, and we think that's going to have better growth than our own banking space. So we own Aussie banks. I'll put that off. We have that in our growth and income portfolios. I'm just going to pull the growth portfolio back up here because this is the most popular Market Matters portfolio out there, we have ANZ at a 6% weighting, and we've also got NAB at a 6% weighting. So we are a little bit underweight the banks. But when we flag UBS, we like that as one of our high conviction 7. So I hope that gives you a quick wrap up of our high conviction stocks. And I've got a bunch of questions that have come through prior to this webinar that we're going to get onto very shortly. Have you guys got anything else to add that you want to add before we move on to questions?
No, looking forward to the questions, James.
Let's get it going.
All right. So the first is coming from who have we got here? Who are we going to go first? Oh, Gerald, this is a topical one. So evolution. What's our view on evolution? Obviously, Shawn mentioned it before. They've come out with a cap raise. They're raising $525 million. They're buying North Parks. It's a copper gold mine in the central west of New South Wales. The stock has come back pretty materially today. So they raised it at 380 overnight. It's trading at 355 at the moment. So when you think about it, they did go into a trading halt and they have dropped. The other gold stocks have dropped about 6% since Evolution went into a trading halt. So put that into context. Shawn, what do you think of that at the moment?
I made some notes this morning, and I've spoken to a few subscribers about it. That mainly because they couldn't get logged into the website properly, so they ended up asking me about Evolution while they grabbed me. One of the notes I made this morning and hadn't bounced it off you was thinking about trimming back Northern Star and increasing Evolution into this raise. I believe around these levels it's really, really good value, and I love the fact that they're just tweaking away from pure gold up to copper. So because coming back to what we discussed before, you've mentioned a few times, we are managing portfolios. Our growth portfolio is heavily overweight gold, and we're very bullish gold. It hit 2100 this week. It made a new all-time high. I believe that's the start of a move over the coming years. And I think this growth portfolio, until further notice, will be overweight gold. But overweight gold, if you're talking about almost a pure gold position of 8%, that's hugely overweight gold. So I'm looking at maybe we should trim back Northern Star, increase Evolution into this pullback. I think that's good value. I also wrote down sell Northern Star, increase Evolution, and buy IGO. You've mentioned Pilbara today. Maybe it's time to start looking at those lithium players. So I'm looking at investigating these things. We'll bounce them off you in the coming days, James. But in summary, I think Evolution into this raise is really good value. I think it's oversold. And we're more likely to have a bigger position rather than a smaller one in the coming weeks.
Yeah, to give you an idea about, we've owned Evolution prior earlier than we owned Northern Star. We had Newcrest that became Newmont. We did exit out of Newcrest, or Newmont as it's now called, prior to it going over to the US and having CDIs available on the ASX. That's why we've got a larger position in Northern Star. Evolution's still up 30%. Northern Star's up 10 odd percent in a short amount of time. So I actually like that idea, Shawn. Harry, have you got anything else to add there? So they're spending $720 million on North Parks. To me, it looks like a good acquisition.
Yeah, I think it probably is, fully priced. It was a competitive tender, like you've mentioned a few times today, James. So it is probably the top end of what they should have paid for it, but it is, a producing asset. It's near to Kowal, which is one of Evolution's key assets in New South Wales. So they know the area, they know the space. I think, more gold and more copper, straight off the bat, is a positive for Evolution.
So next question is from Deb. Why did we sell Wesfarmers when others like it? So yeah, it's not a bad question. It's a good question, Deb. But one of the things you'll notice with is we sort of tread our own path. So where we get more concerned when everyone likes something, and we get a little bit more bullish when everyone has thrown something out or kicked it to the curb. Shawn made mention of IGO just then. No one wants to touch lithium stocks at this point in time, and I think that's probably not a bad time to start looking at them. This was in our income portfolio. So if you go into Wesfarmers, you can see our rationale for selling it. So you go into the action component, then you see are selling Wesfarmers. We then, this is the alert that was sent out to subscribers at the time. Basically, we discussed Wesfarmers here, concluding that we like the medium-term prospects, but we've turned more neutral in the short term. So we sold it about $54. The reason we sold it, and this is only, the Bunnings Wesfarmers is very much a discretionary retailer, right? They've also got a few other industrial components to their business, but ultimately the bulk of their earnings are coming from discretionary retail. The growth engine here is all about lithium. Lithium prices have created, and I think it gets tougher in terms of the consumer going into 2024. We got confirmation of that with another holding we've got, which is Metcash. So Metcash came out yesterday with their first half results, and they did highlight, and we wrote about this morning in terms of Metcash. They highlighted the softness in their hardware division. So their hardware division is their growth engine of the business. So to me, that really confirmed why we sold Wesfarmers, and we used strength in Wesfarmers. We took about a 22% profit in that position, recycled the capital into ORA. So that gives a sense of how we like to trade around the edges there. Uranium is the next question. So
I would just add to that, James, at the moment, that we are in a situation where, the lithium stocks have been hammered. And if you're going to play a lithium stock, I think it makes much more sense to take on a pure risk reward lithium play, looking for a recovery, than look at the quasi play through the Wesfarmers growth when you've also got the problems of discretionary spending. Keep it simple, stupid.
Totally. We've got a couple of questions here around uranium. So Robert, we've got Sam, we've got Bruce, all asking about the best way of playing uranium. We spoke about Paladin today. Harry, is there any other? You bought Paladin very well in your emerging companies portfolio. Have you got any other suggestions around ways to play uranium?
Yeah, Paladin's still our key pick. I would highlight Peninsula Energy, PEN, in terms of a cheaper way to play it. It is sort of a little bit further away from production, but they've done it at recent capital raise, and that's now starting to look cheap. I know Robert's asked about Elevate, EL8. Uranium Explorers, they're an interesting one. That's actually in a trading halt at the moment. Boss Energy raising money. I wonder if there's a deal playing out between EL8 and BOE. But I don't know if it's the right way to play it right now. The Explorers, despite Elevate, probably copying a bit here and now, I would say. But I think Paladin in terms of big caps, Peninsula in terms of relative cheap, and also Silex is one we own. SLX in the emerging companies portfolio is a little bit of a different way to play. Uranium, it's a technology play that enriches uranium, so gets it ready for nuclear power. So that's an interesting one we like there as well, James. A couple of names there for you to touch on.
I think also you can also look at ETFs here. You've got the URNM ETF, gives you a bit of a broader coverage across the uranium space. And for people that don't want to bore too closely into one individual stock, especially as it can be quite a volatile space, I believe that the ETFs are quite good, and they give you some overseas exposure too.
They do. The only thing I'd caution about ETFs, because it's a small, small number of listed companies, the ETFs are big weightings they can have big weightings in smaller companies. So they can influence those companies, the on market, how those companies trade on market, but the ETFs themselves can be influenced by the moves in the smaller companies. So if you want to stay, to me probably the lowest risk way of playing uranium is through Cameco, listed overseas. We've got that in our international equities portfolio. Paladin is our favourite ASX listed company that Harry said, and then there's all the derivatives thereof. This is probably a good chance to bring in. So Michael's question was all around lithium, and asking the difference between producers and explorers, developers, as the lithium prices fall. I'm a little bit perplexed. I'll take this one first of all. So prefer we operate primarily in the larger cap space, where we've obviously got emerging companies portfolio, which looks at some explorers in some parts. I'm perplexed that a lot of companies are going out there and buying explorers relative at higher prices relative to producers. So I think producers have been hit so much that we should be looking at those producers. So Pilbara, IGO in the large cap space. We do have a producer in the lithium, a developer in the lithium space, Harry, called Global Lithium. That's one that we still like, but it has been weak in terms of share price.
Yeah. Obviously, lithium price has been under pressure. That puts the explorers under pressure as well. Yeah, GL1, it's sort of a special case for us. I think they've got a couple of pretty exceptional assets. They obviously need a bit of money to get them up and running, but if we do see this lithium price turn a little bit, these are the tier one assets, or could be the tier one assets that the market will really enjoy. So that's a stock we do like, and small allocation in the space for a turnaround in lithium.
Yep, absolutely. I certainly agree with you. In terms of, so we've got one last question I'll just address here. There are a couple of others, so apologies if we haven't got to your questions today. Just on fund managers, this is an interesting one because Pete has asked, I've been caught holding too many fund managers for yield. Is there hope in this space? Pete, we can only do general advice, so we're not taking into consideration your personal circumstances. I'll just getting Perpetual up here because they've come out today basically with a strategy update at their AGM, and they're looking at spinning out the trust business with the wealth management business, a funds management business. So I think there's, from a broad brush perspective, I think fund managers like Perpetual, like Magellan. I know we've got Magellan in 2 portfolios. Subscribers hate that we've bought Magellan, but I think there's a lot of underlying value in that business. If you break up the parts, it's worth more than what the whole is trading at the moment. And I think that's still the case with Perpetual. Their trust business is worth about $1.4 billion of the 2.5 billion market cap of this company. You then spin out a very big funds management business that just acquired Pendle and the like. So I get what you're saying around holding too much of them. And a lot of people have been caught looking at the yield only in terms of the fund management businesses. I think the ones that you want to be targeting are the ones with underlying value in other parts. So whether that's principal investments like Magellan has got, or they've got really valuable components of their business, like Perpetual has in terms of their trust operation. You can see on the chart there, Perpetual has recovered from those lows, and Magellan has as well. So that's been a bit of a difficult one for us. We're down about 6% on the position. We've got it in 2 portfolios. We're down a bit on the position, but nothing material. Anything to add there, Shawn or Harry?
Yeah, it feels worse. Magellan certainly feels worse because it did go our way to start with. And obviously it came out with yet more bad news about cash flows. But I do think that the risk reward is looking quite attractive down here. I just wouldn't throw the kitchen sink at it. I think you've got to recognize it as a recovery play and apportion investment size accordingly, like we have.
Yeah, I mean we've got 4% in Magellan in the income portfolio. I fielded more grief buying Magellan than any other stock in the past 12 months.
I think it was matched by when we sold CBA.
Yes. Yeah, exactly right. We're down 1% in the income portfolio, and we do have it in the growth portfolio, and I think we're down about 5% from memory. 6%. There you go. Harry, any thoughts on the funds management space? I actually
echo those thoughts on Magellan there. We do own Regal in the emerging companies portfolio as well. It's a little bit more dialed up way to play the space. But yeah, very interesting business. I think you wouldn't want to be one to bet against Phil King. I think that's a pretty hard side of the trade to be on. So backing him in at the moment.
Yeah, so we have that, in the emerging companies portfolio, Regal at RPL. I'm going to wrap it up there. We've had a great attendance at today's webinar. I hope we gave you some interesting insights around 7 high conviction stocks that we like here and now. We're always reticent to sort of flag these sorts of singular positions. We've done so today in the context of a portfolio, but I'd stress that the advice provided today is general only. We do operate on a portfolio basis, so we're all about maximising returns at a portfolio level. So the Market Matters portfolios typically have up to 20 positions in them, a little bit more in terms of our emerging companies portfolio to give us a bit more diversification. But we like that sort of concentration of a 20 stock portfolio. So going out there and hanging our hat on 7 positions across all of our portfolios is a little bit edgy. Still, we've done it. So thank you very much, both Shawn and Harry, for your insights today.
Thanks, guys.
Thank you.
And thanks to all of those Market Matters subscribers on the line. We hope you've had a great 2023. I hope you have a wonderful Christmas, a prosperous New Year. And for all the team at Market Matters, thanks for joining us throughout the year. For those who are members, look out for some membership renewal offers going into Christmas. For those who are trialing our services, thanks for doing so. There'll also be some offers out there for you. If you've got any questions, go through the Market Matters information pipe, give the office a call, jump on the website. There's a raft of information that will get you across all of the services that Market Matters had to offer. So thanks again, and bye for now.